Stocks or real estate? Should you invest in one? Should you invest in the other? Should you invest in both? Is there an order to how you should invest in them? It's the age-old question, stocks versus real estate. And I found an interesting perspective on that issue from this book that I've been reading. This is Peter Lynch's book, One Up on Wall Street. Peter Lynch being the very famous stock investor who ran the Magellan Fund when he worked at Fidelity, which is one of the most successful funds of all time under his tenure. I've been meaning to read this book for quite some time, and I'm not quite done with it yet, but definitely would recommend it to anyone interested in investing. But I want to go over this very specific section that is towards the beginning of the book, actually, and I was very surprised when I read it. It goes to this question about whether you should invest in real estate or stocks, but in a different way than you might expect. So it's in this section called Passing the Mirror Test, and the whole point of this chapter is to determine whether you're ready to invest in stocks, since when you're picking companies, which is what the book's really about, is picking quality companies and quality stocks at good prices. And there's a lot of discipline involved with this, and also there's risks with any investing, so he wants to make sure that you're well equipped to do this. And one of the main things that he points out here in the section is, number one, do I own a house? In fact, the first few lines say, before you do invest anything in stocks, you ought to consider buying a house, since a house, after all, is the one good investment that almost everyone manages to make. I'm sure there are exceptions, such as houses built over sinkholes and houses in fancy neighborhoods that take a dive, but in 99 cases out of 100, a house will be a moneymaker. He goes on to say that complete amateurs often make a lot of money in real estate when they're buying their house for a couple of reasons, one of them being the fact that a person actually holds on to their house for a very long time, whereas with a stock, you might be more inclined to sell it at a moment's notice, and that might not always be a good decision. And often when it comes to investing, holding is one of the best decisions you can make if fundamentals haven't changed. Of course, not financial advice. Every situation is different, but for most people, it makes a lot of sense to hold an investment for the long term rather than try and time things in the short term. And to that same point, with a house, more often than not, you're not going to have nearly the same amount of financial news and pressure around your specific home price. As it fluctuates with the market, a home price will fluctuate too. However, unlike a stock, you're not seeing a ticker symbol go by every single day telling you what your home is worth, unless you're checking Zillow every day or something like that gives you a Zestimate and tries to tell you what your home is worth. It's very different though from stocks, where you have all these different alerts, all this short-term news, panics, everything like that. That often doesn't happen with your specific house. You're buying it to live in it most likely, and therefore you're not nearly as inclined to sell it. And I think an analogy that Warren Buffett has made in the past is you don't have a person standing outside of your building shouting prices at you every single minute, which is kind of what the stock market is. You see a price in real time, seeing what that thing is trading for, and that can go in the upswing or the downswing very quickly, and that can be pretty stressful, and it just doesn't bode well for our psychology as humans. So that's one of the benefits that Lynch points out, but another one, a very big one that he points out, is leverage. That is the ability to put debt on a house at very favorable terms, to where if your home goes up in value, it's multiplied by the power of leverage, and unlike a margin loan or something like that, the debt isn't callable in most cases, since it's a fixed rate loan in many cases, because the government subsidizes mortgages in huge ways to give these amazing products to people who buy homes. Of course, you need to qualify for the loan in the first place, which can be difficult to do, but if you can, you have a massive power of leverage behind you to where you can multiply your returns many times over in real estate if you hold for the long term especially. Now, you can multiply your returns in stocks as well by using debt with margin loans, for example, but that is a different set of risk factors, especially because margin loans are subject to margin calls, as in if your stocks fall in value too much too quickly and the value of the loan is actually equal to the value of your stocks or something like that, or even worse, the value of your stocks falls below the value of your loan, that is typically going to trigger a margin call to where the brokerage or whoever's lending you the money is going to force you to liquidate your stocks and then pay back the margin loan, and then you're back to zero, and that's no fun, and that is always a risk with any sort of margin loan. And another bonus that Lynch points out as it relates to real estate debt, at least in the US, you get lots of great tax benefits in many cases, such as mortgage interest deductions, to where the interest on your loan is actually completely tax-free, and you get a deduction on your earned income. That's a huge benefit, potentially, especially if you have a pretty hefty mortgage. And you typically can avoid a lot of capital gains taxes as well with a primary residence, since the government has a lot of tax loopholes built in to allow homeowners to sell their property even with a gain without paying taxes on the gain up to certain thresholds. Speak to with a tax professional, of course. I am not a tax professional, but there are a lot of great advantages built into the system. You just got to find them and make sure you're doing them properly. The point is because they're there for the taking and they can make real estate a really fantastic and powerful investment. And the last thing that Lynch points out about buying a home first as opposed to investing in stocks is the fact that people are often much more careful when it comes to buying a home or a piece of real estate. You're going to hire inspectors, an appraiser. You're going to have multiple experts come out if there's a problem with the property. Whereas in many cases, people don't do anything like that with stocks. They're just going to take one quick look at the recent history of the stock chart, if that, and then we'll buy it. Or they're just going off a tip from someone, an anonymous tip, and decide to throw a bunch of money into it. It's very different for many people. Of course, this isn't to say that some people don't actually do the due diligence process for stocks, but it's just less common, it seems like, compared to the average home buyer. Now, while Peter Lynch doesn't directly say that buying a home is absolutely necessary before you invest in stocks, he really encourages his readers in just a couple pages to consider doing that first, almost as a sort of foundation before getting into it, just because the benefits of investing in a home, even though it's not truly an investment in that it's often more of an expense, but you still get a lot of benefits compared to something like renting, for example. You're building equity in the property, get those great tax benefits, and if you're doing your due diligence, you can often make sure you're actually getting a pretty good deal on the property. Of course, you got to be careful there too. Now, this doesn't mean that you should overpay for a property, and it definitely doesn't mean you should over leverage yourself and get into a property that you struggle to afford, but it is food for thought. Maybe it makes sense to really focus on getting a home first before you start investing more heavily in stocks. That's certainly something I did. The first thing I did out of college was try to get into a house hack as quickly as possible. That's where you buy a property, maybe a multi-unit. I bought a condo with an extra bedroom and bathroom. Then I rented out the extra space to offset my mortgage and living cost. And that way I had a lot more savings that I could then invest in other things, including another rental property and then more heavily into stocks as well. With real estate, you also have the chance to force appreciation where you can do some rehab on the property, maybe some quick fixes here and there, or even more substantial rehabs. And that can be a great way to force a lot of value added into the property, which can then be translated right onto your net worth. So there are other things you can do with real estate besides simply just renting out the space. That's always great for income and really getting that cash flow position in a good place. But you can definitely catapult your wealth, especially when you're using leverage, when you can force appreciation in the property using largely other people's money. Of course, be careful with any amount of debt because no amount of debt is truly 100% safe. That is some sort of risk added to the deal. But if you can muster it and do it well, you can really add a lot of value on the back end, and that money can be invested in more deals or in stocks or whatever it is you want to spend money on. And one big benefit that I've really experienced with investing in real estate first before really getting more heavily into stocks, I'm still a real estate investor at heart, but that perspective of knowing how to analyze a real estate deal, I think has really helped me for analyzing companies and analyzing stocks to whether they're a good deal or a bad deal on a given day at a given price. Since a good company, like a good piece of real estate, is going to have cash flow, and that's what you're looking at. You're seeing, does this company have cash flow or will it have cash flow? It's highly likely that it's going to have it in the future, and you're not making super overly ambitious assumptions, or if you are, you better adjust the price accordingly to discount that in case that doesn't actually pan out. That's what I'm doing when I'm looking at stocks, and that's what a lot of guys like Peter Lynch, Warren Buffett, and other larger investors and very successful investors at that, that's an approach they're doing. It's not the only approach to take with investing in stocks, but it's definitely one that I've bought into, and I think this makes a lot of sense coming from the real estate world, where you're looking at a property, seeing its cash flow position, what's going to happen to that cash flow position if I do X to the property, what's going to happen to the property value. But for many people, when they invest in stocks, they don't look at any of the underlying fundamentals, and they just go off of feeling or emotion. They maybe like the company. Lynch talks about that a lot in the book. People will buy just on the fact that they like the company, which maybe is a start for inspiration, but that in itself doesn't tell you a whole lot about the business other than that you might like the product. But that is just the start of an analysis on a stock, in the same way that, hey, I like this property down the street. It looks really nice, but that doesn't mean it's actually a good deal. The price you pay is ultimately what determines whether something is a good deal or not, and that goes for a piece of real estate or a stock. If you're overpaying for something, it's not going to be a good deal, but if you get it at a cheap price relative to its actual value, you should be doing well for the long run, so long as everything goes okay. So back to the initial question, does it make sense to invest in stocks or real estate first? Well, Peter Lynch would suggest real estate, or look very closely at that. If you can get a good deal, I would definitely encourage it as well. Not financial advice. Everyone's situation is different. Maybe you hate real estate, don't want to ever own any of it, or you're just in a market where it's so expensive, you don't have the money to do it, but you really want to start investing, or you have a passion for investing in stocks and you're careful about it and you know what you're doing, or you have been doing a lot of due diligence in your strategy and really have a firm understanding of what you're actually doing, then great, go for it. Then it's probably a good idea too. too. But if you're just investing blindly into something, that's probably not a good idea in any asset class. So I think the central lesson here is to make sure you're doing your due diligence and you understand what it is you're buying. And if there's extra benefits related to what you're actually buying in the first place, that can be a great place to start. Investing in real estate isn't necessarily better than investing in stocks and vice versa. So it's not as though one strategy is always going to be better than the other. It totally depends on the situation and the deals that you can find. So there you have some thoughts on real estate from one of these stock goats in Peter Lynch. Maybe take a close look at it. If you haven't invested in real estate before, you don't own your home, could be a great thing to actually look into doing. If you can do it right, you got to be careful with any sort of investing. But in any event, if you guys want to check out this book, I'll go ahead and include an affiliate link in the description below. That would help the channel out a lot. And hopefully you enjoy reading this like I have. That's pretty much all I've got for today. If you like this video, please like it since it would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.